Welcome to Furniture Industry News. Today is Friday, July 31st, 2026, and thanks for joining us. This was earnings week, and lining the results up side by side, something jumps out. Almost nobody in this industry grew by selling more furniture. One of the best-known names in American home furnishings shrank its top line and improved its margin anyway. Another more than doubled revenue, while its underlying business grew 0.1%. A third beat expectations with negative comparable store sales. The growth right now is coming from how these companies are built, not from customers walking through the door. Let's get into it. Start with Ethan Allen, because their fiscal year just closed. Full-year net sales came in just under $580 million, down about 5.7%. Fourth quarter was worse, down roughly 8.5%. Here is the part that matters. Gross margin for the year went up to 61.2% from 60.5%, and they finished debt-free with $187.5 million in cash and investments. Think about what that means operationally. This is a company that lost almost 8.5% of its fourth quarter volume and still sold what it did sell at a better margin than the year before. Two things make that possible. They own their factories, and Chairman and Chief Executive Farooq Kathwari points out they make roughly 75% of their custom furniture in their own North American plants. And they lead with complementary interior design service rather than with price. Neither of those is something you can install next Tuesday, but the discipline underneath them absolutely is. If your sales came down this year and your margin came down with them, discounting is doing work that your presentation should be doing. One more detail worth your attention. Their fourth quarter operating cash flow was $22.4 million, and $5 million of that was tariff refunds. Refund recovery is a real line on the cash flow statement now. If you import and have not had somebody go back through your entries, there may be money sitting there that belongs to you.
Now HNI, and this one is a lesson in how to read a press release. Second quarter net sales, $1.47 billion, up 121%. Enormous number, except almost all of it is the Steelcase acquisition that closed in December, which contributed roughly $807 million. Take out the acquisition, and the organic business grew 0.1%. Both numbers are honest. They answer different questions. The detail I would actually pull out of HNI's quarter is buried in their smaller segment. Residential building products saw sales fall about 1.5%, but adjusted operating margin in that segment expanded to 20.4% from 15.7%. Sales down, margin way up, and the reason they give is that growth in remodel and retrofit work offset continued weakness in new home construction. That should sound familiar because it is what furniture retailers have seen since spring. Remodeling money is moving, new construction money is not. If your assortment and your advertising are built around the family closing on a brand new house, the volume right now is in the house somebody already owns. The housing data backs that up. New single-family home sales in June came in at 628,000, down 5.6% from a year ago, though up slightly from May. Prices are coming down too. The median new home price fell to $398,300, down almost 3% year over year, and the average price fell 6.5%. Supply is sitting at 9.3 months. Regionally, it is lopsided. The West was down almost 25% from a year ago, while the Northeast was up 16%. But here is the number in that report I would actually put on your wall. Single-family completions came in at 964,000, up 6.6% from May. Sales tell you about sentiment. Completions tell you when somebody needs a sofa. Those are two different clocks, and completions is the one that pays you.
On the consumer, two readings came out this week, and they disagree in an interesting way. The Conference Board's confidence index slipped again, down a little over a point to 90.8, and its present situation measure fell for a third straight month. Their chief economist noted that views of both current business conditions and the current job market softened. But dig into what people say they intend to buy, and among durable goods planned in the next 6 months, furniture was still one of the two most desired items on the list. Home buying intentions kept trending up as well. So the mood is sour, and the shopping list still has us on it. Both of those are true at once. Meanwhile, the University of Michigan Sentiment Index actually rose for a second straight month to 55.2, up from 49.5 in June, still 11% below where it was last July. Their survey director put it plainly, consumers do not feel like they are thriving in the current economy, and she cautioned that continued shipping problems in the Middle East could make that improvement hard to hold on to. One new wrinkle worth noting. For 3 months running, at least 10% of respondents brought up artificial intelligence on their own without being asked, up from under 1% at the start of last year. Negative comments outweigh positive ones, mostly around job loss and data centers driving up local electricity bills. So AI is in the consumer's mental model of the economy now, not just ours. Now trade, and this one reframes something. We covered the 50% tariff on Canadian goods a couple of weeks back, and most of the conversation around it has been about imports getting more expensive. But look at the flow the other direction. Canada was the top export market for American-made furniture last year at nearly $1.5 billion. That is roughly 60% of everything this country exports in furniture going to one customer, and Canada has held that #1 position 5 years running. Canada also ships almost $1.7 billion of furniture into the United States, which makes it our #4 supplier, with wood furniture right in the crosshairs of the tariff list.
So a trade fight with Canada is not just a sourcing problem for importers, it is a demand problem for domestic manufacturers, and it lands while American plants already have capacity to spare. There is at least one workaround already in motion. A Canadian wood producer called Burmex bought the manufacturing assets and capacity of Saloom in Winchendon, Massachusetts last year. That gives them United States production, a route around tariffs on much of their line, and it saved American jobs in the process. The idea being floated is a lighter version of the same thing, licensing or contract manufacturing deals, where an American plant with open capacity produces for a Canadian partner and collects a fee based on volume. American plants face a 25% rate under a different tariff authority, so shared capacity could pencil out well below 50%. That is a proposal, not a done deal. But if you buy from a Canadian vendor, there is a specific question for your next phone call. Does that supplier have United States capacity or plans for it, and on what timeline? That answer will shape your fall pricing more than the headline rate will. On freight, container rates fell for a third consecutive week, with the World Container Index down 3% to $4,255 for a 40-foot box. Shanghai to Los Angeles came down slightly. Shanghai to New York held flat. Do not celebrate. Rates are falling because import demand is soft, which is the same condition holding down your sell-through. And several carriers are adding emergency fuel surcharges starting in August, tied to the Middle East, so part of that relief is about to be taken back. The real risk there is capacity, not price. 8 trans-Pacific sailings are scheduled to be canceled next week, up from 7 the week before. That means a container you booked for a September floor set can slip a week or two without one number changing on your invoice. Build that slack into your fall delivery promises now, rather than explaining it to a customer in October. And read the surcharge language in your carrier agreements, because fuel adjustments very often sit outside the rate you negotiated. The reason for all of it got worse this week. Iran's Revolutionary Guard says it struck 2 oil tankers trying to move through the Strait of Hormuz under American military air escort, and that 4 more turned back. That claim has not been independently confirmed.
2 more things, both about your own operation. A survey of more than 50 executives across more than 30 furniture brands asked a simple question: where does execution actually break down? Not budget, it turns out. Most of these companies plan to hold or grow technology spending. The problem was friction that piles up after the decision gets made. Number 1 was back-end systems and integration, where data exists but does not move, so people move it by hand. Number 2 was launch speed, products fully designed and priced and ready to ship, but still weeks or months from showing up on dealer portals and sales tools. Number 3, and this is the one I would take to your next management meeting, was customer service and order handling. The survey frames that not as a service department problem, but as an upstream one. Bad product data, fuzzy configuration rules, and pricing gaps all surface at the very last place you have any leverage. If your service team spends its day correcting orders, the cost is being created at order entry, and no amount of service training touches it. Count the touches this quarter and put a dollar figure on the friction before you approve another platform. Last thing, and it is about the calendar. 2 separate consumer surveys landed this week saying the same thing. 83% of shoppers will start planning holiday purchases before Black Friday, 71% will start buying before it, and 46% will start buying gifts before November arrives. Meanwhile, most shoppers do not expect brands to launch holiday promotions until November, and 54% now say Black Friday and Cyber Monday are not critical to them because deals run all season anyway.
2 takeaways. First, the response rates on personalized triggers are extraordinary. 90% of consumers say they act on a price drop alert for something they showed interest in, and 88% act on a discount for something they recently viewed or left in a cart. That is the cheapest conversion available to you, and most stores are not using it. If you capture contact information at a design consultation and then never follow up on the exact configuration that shopper looked at, you are leaving the easiest sale of the season on the floor. Second, watch the stated reason people expect to spend more this year. Among those planning to spend more, 64% say it is because inflation raised the cost of gifts, not because they are feeling generous. So plan units flat and ticket up, not the other way around. That is the week. The companies posting good news right now are not the ones with better traffic. They are the ones who fixed something structural before they needed to. If this was useful to you, please subscribe. Thanks for listening.